At Investing Unscripted, we ask and answer the hard questions about investing. Our Savvy Trader portfolio is an extension of that mission, and it's our attempt to show that frameworks, patience, and a bottom-up focus on quality stocks can beat the market. A year into our journey, we are doing exactly that. Not only are most of our stock picks making money, but our returns are almost 51% better than the S&P 500 so far. We want you to join us. For the month of May, we're offering 25% off an annual subscription. That's a savings of almost $75 and gets you full access to our portfolio, trade history, videos and commentary on each stock we have bought, and a preview of our next stock buy before we buy it. That discount code works out to less than half price compared to a monthly membership, but it's only good for a limited time. Click the link to the show description to get 25% off the annual subscription, or go to savvytrader.com/investing unscripted. Use the discount code UnscriptedMay. That's savvytrader.com/investing unscripted. Discount code UnscriptedMay. Hey everybody, welcome to Investing Unscripted, where we ask and answer the hard questions about investing. I'm Jason Hall, joined by my good friend, the voice of the people, Jeff Santoro. Hey Jeff.
Hey, how you doing?
I'm good, man. I'm good. I repeated that because I clanged my foot on something and I didn't know if it showed up on the microphone or not.
Well, now I can't edit it out because then I have to cut all this.
It's okay. It's okay. It's part of the show, man. We make the sausage and show people the sausage making and then sell the sausage.
That's right. Well, it's good to see you on a screen again. It was disconcerting to spend so much time in person with you last weekend.
Way too much.
Way too much.
Way too much proximity. So no, that was a great time. I really enjoyed it, spending time with you. And there were a few other people that kind of in the FinTwit world that we know peripherally that we got to spend some time with, and that was good. But my God, it's so much better to have you on the other side of an internet connection.
I agree. Thousands of miles and a computer screen away is the way I prefer to spend time with you. But it was fun to be in Omaha last weekend. We saw each other. We saw frequent Investing Unscripted contributor Tyler Crow. But the fun part was actually seeing in person several of the guests we've had on over the past couple of years and meeting them in real life and making some connections for some possible future guests. And then obviously we got to be at the Berkshire meeting when the big news dropped that Warren was going to step away. So for anyone listening to this on the day it comes out, there's a whole weird sequence of podcasts at varying different times before and after the Berkshire meeting. Last week's episode was recorded before we went, but dropped after a live stream that we recorded while we were there. The live stream dropped this past weekend. So if you've been listening in order and you're confused, it's just because we're really bad at this.
Yeah, but we're really good at being bad at this. That's the differentiator.
You know what? No one's as good at being bad at this as we are.
That's true. That's exactly right. That's what I said. Why am I repeating you? Because we're bad at this.
Because we're bad at this. Yeah.
But you know what we're good at, or at least I am? That's naming podcast episodes. We're calling the episode this week, When Good Advice is Bad.
Yeah. So one of the things that I was thinking a lot about while we were in Omaha is how much we talk about the lessons we've all learned from Warren Buffett and from Charlie Munger and from following Berkshire Hathaway for many, many years. And it's almost like what they say is just taken as investing truth and investing gospel. It's quippy, it's old-timey. There is a lot of good advice in what they say, but I don't know that all good advice is good advice for all people. And I thought it'd be fun to just kick around a bunch of different aspects of investing that sometimes get pitched as this is how you should do it, or this is the good advice, and just kind of poke holes in it and see where might this not be good advice, or who might this not be good advice for, and who might it actually be good advice for. So that's what we're going to do. I'm just going to talk through some investing quote unquote truths and see how true they actually are.
Yeah. One of my favorite things about this is that we're kind of repackaging an idea that I think is so important that sometimes gets forgotten, because the most honest answer that nobody ever gives in financial and investing media is it depends.
Mm-hmm.
So we're going to talk through some of these things. So I would, as a starting point, Jeff, what of all of the dogmas, the truths of investing, the truths of personal finance out there, what's the one that to you is the one that is the most good advice that's terrible for a lot of people?
I don't know. I didn't give any thought to that yet, but I will say this. I think it's not a specific thing. It's more that you have to buy individual stocks to be to make money in investing. I think that if I was going to pick sort of a 30,000 foot,
The idea of outperformance.
yeah. So
Yeah.
the other sort of partial inspiration for this episode was I was talking to a colleague at work who was asking me about the podcast because he had just found out about it. And I was telling him what we do. And he said, is your podcast like really deep in the weeds or not? Because I don't know anything about this stuff. And I was like, no, it's pretty conversational. It's just should sound to you like two people, having a drink at a bar, just talking about stocks and investing. And he said, good, because I don't know anything about this stuff, but I'm in my mid 40s, so I probably should. And I think, and he went on to say that it's intimidating. He doesn't know where to start. It just seems so overwhelming to him. And I think that's why I answered with the fact that you have to buy stocks might be something that I disagree with. That's sort of pitched out there, especially if you start following social media accounts. This is the way to get rich. This is the way to build wealth. When, you could just buy an S&P 500 index fund for 40 years and be fine and never worry about an individual stock in your life. So I'll probably think of others as we talk through this in terms of which of these I feel is the most pitched as being good advice that might not be good advice for all people. But thinking big picture, I think it's the idea that you have to own individual stocks at all.
There's two things that are the same thing that I've seen a lot of headlines in 15 years of writing and generating content for personal finance and investing. The two that I see the most that drive me crazy are actually around Social Security. And it's this is the best age to take Social Security ones. Now, there's some good ones out there that actually have nuance and explain. Here are the things to think about: life expectancy, health, age of a spouse, spouse's Social Security benefit level, other assets that you have, there's stuff out there that's like that. But I've read them before that say either one thing or the other. And the one thing is wait till you're 70 because you're going to get the most money. That's when your benefit is the largest. Your monthly benefit is the largest. And I've read some that say, take Social Security as soon as you can at 62 because you're going to get the most dollars the soonest. You can take those dollars and you can reinvest them and you can compound them. And both of those things are both excellent and absolutely awful advice. And the reality is neither one of those things applies to most people. There's so much more that goes into it.
Yeah.
But people read those things and make decisions. They inform too much of the decisions that people make about something that is hard to walk back. I mean, there are actually ways that you can kind of hit reset. If you take Social Security and you decide, no, there are ways that you can reset it within months, right? It's very quick. Can't do it 5 years after the fact, but it's damaging advice, I guess is what I wanted to get to.
Yeah. And, I was reading, I want to say it might've been Ben Carlson's newsletter this week. He had the statistic that the average person spends 6 minutes researching a stock. And I think there's probably some correlational statistic for people who do research on when to collect Social Security. They probably Google it and read a couple articles and make a decision. And if you stumble across an article that's full of nuance and weighs the pros and cons, then you'll probably end up in a better place. But if you stumble upon an article that's pitched as this is the right answer, again, people coming at this from very little understanding, or even if, because you could read the one that says, the way you pitched it, right? Do you want to maximize your benefit or do you want to get the money the soonest so that you can do stuff with it? Or even maybe over the course of your lifetime, that's 8 more years of collecting and maybe that overcomes the higher income if you live long enough. But you might read that and go like, oh, that makes perfect sense. I'll do that. And not even consider the other side of it because it is logical, right? Yeah. Oh, by taking it at 62, I'm collecting 8 more years than if I wait till 70. I think that's a good one. I guess there's a bunch of, I don't know if I have like a number one specific thing, but here's one that I hear a lot that I wonder about, which is the cadence of buying, like when and how you should buy investments. And I think I agree with a regular cadence if it's something like a retirement account, right? Like just money coming out of your paycheck every 2 weeks and going right into whatever, the mutual fund or the index fund that your retirement account is in. That I think is actually good advice for everyone. You don't want to be, I don't even think you can, but you wouldn't want to like willy-nilly be investing into like your company 401k. But as it pertains to stocks, I feel like there are some people who will say every 2 weeks you should buy something, or you should buy in thirds, or you should buy in halves, or you should just make a decision and lump sum buy on that day, or you should dollar cost average over a year, like all these different kind of ways to buy into stocks. And some people feel so strongly about it that they pitch it as this is the way. And I think that very much depends on the person. It depends on the amount they're investing. And I think it can change over time. It's changed for me in 5 years, the way that I started versus where I am now. So what do you think about that one?
Again, it's that unsatisfying answer of it depends. I will say this. I do think with younger investors, younger people allocating capital, having a cadence of regular investing early is far more important than trying to maximize the returns of every dollar that you get and waiting for pullbacks or trying to get a good valuation. And there's a couple parts of that. Number one, most new investors don't know what the hell they're doing. Let's be honest about that. They've probably read some books, listened to a podcast or two. Now the podcast is fantastic, but the books might have been dodgy, and the people that they follow on social media are questionable at best. At least the ones that post all the time, because they spend all their time marketing whatever they do and not actually developing their skills in the discipline they claim to be an expert in.
Mm-hmm.
So now that I've dogged everybody else in the financial services world, except for you and me, well, the other podcasts too, but mostly
Well, the reason we're not on social media more is that we're really busy not preparing for this.
We work so hard at not preparing for this. So, but no, in seriousness, the point is that when people are new at anything, they really don't know what they don't know, and they don't know what they're doing. And the funny thing about investing is if you're 25 or 35, the most powerful thing that you have in your back pocket is 30 or 40 years before you have to start touching that money if you're saving for retirement, or 10 or 15 or 20 years if you're thinking about a kid that you don't even have and maybe building out that wealth, or buying a vacation home when you're in your 40s or 50s or whatever, right? You can start measuring things in decades where if we look at the numbers, I've talked about it before, right? So you bought in January of 2000 or October 2007 or February of 2020, these peaks, and more recently, January of 2022, these peaks right before these big market sell-offs, you've still done pretty darn well, right? Like for the worst time that you could have bought stocks for years and years after it, the decades start kicking in and the market's outperformance makes up for those mistakes. So making that regular habit of cadence of buying, particularly as long as you're learning along with it, right? And I want to give you a lot of credit because you weren't just buying stocks. You weren't just looking at lines on a screen. You were studying businesses. You were learning about competitive advantages. How important does management matter versus the business? What is a moat? Finding businesses with tailwinds, like all of just the 101 stuff as an investor, you were doing all those. So it's not either or. You were doing that and also had a regular cadence of investing. But as you've become more skilled as an investor looking for opportunities, you've slowed your cadence as a buyer of stocks, right? Because you've become more skilled of looking for opportunity. You're not trying to time the market in your actions. And my concern, and why I think that this is generally directionally, there's a good seed there, is that it gets people going. It gets people doing something in a time where doing something, as long as it's buying, is the most important thing that you can do. And then they can tailor it as they go on. But the idea that you have to constantly be buying all the time, I agree. That's bad advice.
Yeah, and I agree with, if you're going to err on the side of buying regularly or irregularly, it makes sense when you're a newer investor to do it regularly, because otherwise you'll start to time the market, whether you think you are or not. And I think I've heard people say, but if you look at the data, dollar cost averaging reduces your returns over the long run because generally stocks go up and blah, blah, blah. And I think when you're buying into an index fund that tracks the S&P 500, I could see where that's true, right? Generally, the S&P 500 goes up. So every time you buy, or a lot of the times you buy, you're buying at a higher price. But I think that's the thing that prevents you from going to cash 2 days after Liberation Day. because
Right, exactly.
the market dropped 10%. All right, so here's one that you had on your list that I think is interesting because it ties directly to something we heard Warren Buffett say last weekend, which is about having cash, right? Keeping cash in your investment portfolio, or dry powder, as a lot of people call it, because you've talked a lot about how you use cash, but Warren Buffett said in the meeting on Saturday that they've made a lot of money by having a ton of cash on the side. Now, the reason I wanted to bring that up is it's sort of the genesis of the show. We think of all the things that Buffett and Munger say as being gospel. And I think I could see a lot of investors hearing that and being like, yeah, absolutely, I should keep cash on the side so I can be opportunistic. And I think that can be a valid investing strategy for some people, but I think the context is where it's important. The reason that Berkshire Hathaway keeps, what is it now, $330 billion of cash on the side is because when they make an acquisition,
yeah, that's roughly it.
Yeah, because when they're making an acquisition, it's going to be like of an entire business, or
Right.
or most of a business, or a big chunk of a business, and that's not the boat that we're in. But I know that me personally, right now, where I am, like, I wouldn't want to have a huge cash position because it would be too tempting. I would think every day is the right day to deploy that cash.
Yeah.
So for me, it's bad advice, but for you, it's great advice. So how do you think about that one?
So Buffett's talked a lot more about cash over the past 3 or 4 years because the value of cash on the balance sheet has changed. For most of the past 20 years, cash was a massive headwind to compounding returns because the yields has been so incredibly low. Yields jumped up into the sevens, right, for a while. And now cash gets about 4% yield, a little better than 4% yield the Berkshire can get on most of its cash because they don't want to lock it up for years. They want to have it available to deploy within months or weeks even. But I want to put some numbers to it to really contextualize what Buffett's talking about. Again, cash generating roughly 4% yield, right? So you can compound it at about 4% a year. Since Buffett took over Berkshire in 1965, so 6 decades, Berkshire has averaged 20% a year in compounded annual returns. So cash is generating 1/5 of Buffett's average. He's a lot less happy with cash than he's saying. He is willing to wait for the right opportunity to deploy that cash. Mm-hmm. I think we should be very clear about that. Buffett will take 4% if he gets the opportunity to buy something that's going to generate 15%, right? And he'll sit on cash for multiple years until there's opportunity. He's not going to blow the cash to buy something that's going to generate 7 or 8%. He's going to take the time because once that cash is deployed, the idea is to get that double-digit rate of return for the next 30 or 40 years. That's the goal. That is the long-term goal. So I think that's an important thing to remember about the way the business is built and their willingness to be patient because they can be, not because they want to be. They're choosing to do that. And the bottom line is that this is bad advice for most people because 4% a year is not going to get you to your financial goals. That's the bottom line, right? You can get better than that in long-term, really high-quality corporate debt, right? Much less holding it in cash. You can underperform the market's long-term average and do twice as good.
Right.
So that's why I think it's bad advice. And the other part about it too, for me with cash, is because cash is something that investors can fall in love with, right? You can fall in love with that optionality and the idea that you're going to time it, you're going to see the big sell-off and man, you're going to have all this cash, you're going to put it to work. And then it finally happens and you get a drawdown, a 25 or 30% drawdown, but the market's up 300% since you started holding that cash. So you're still starting out, you're not starting out in the basement here. You're starting out on the 5th floor. So I think that's an important thing to remember. And the other part of it to me about cash is that because generally cash is unproductive, right? In terms of, as an investing asset, it's the most important asset to have available to deploy quickly. But in terms of a compounding asset, it's unproductive. It's a great mindset asset, right? It's a great way to help optimize for how you're going to get the best out of your portfolio. Because a lot of investors, Peter Lynch has talked about the fact that he stayed as fully invested as he could. And in his own personal investing, he stayed fully invested without having a bunch of cash sitting around. And that's because he's optimized for himself and also really damn rich, which makes it easy to stay 100% invested. That's not the way it works for everybody. For me, I need to have around 10% cash. It's kind of the threshold for me because that keeps me from that other 90% that's invested in stocks and bonds. I don't mess with it. I leave it alone. I let it work. And then I have some capital available for me to deploy.
Hey everybody, we'll be right back, but first a word from our sponsors. FinChat.io is the complete stock research platform for fundamental investors. They have all the standard financial data on more than 100,000 stocks globally. But beyond that, they have company-specific segment and KPI data on around 1,800 stocks. So for example, do you want to see NVIDIA's data center revenue growth? They've got it. Do you like to track Apple's iPhone sales? They've got that too. Or how about nights and experiences booked for Airbnb? You guessed it, they've got it. And they just added around 8,000 ETFs and mutual funds to the platform. The breadth of FinChat's data is truly one of a kind. I use FinChat every single day as I'm researching the stocks in my portfolio, specifically when I want to see how they're doing on KPIs that FinChat is famous for. So to get 15% off any paid plan, go to finchat.io/unscripted. That's finchat.io/unscripted to get 15% off any paid plan today. The link will be in the show notes.
Investing Unscripted is brought to you by the Chit Chat Stocks podcast. My name is Ryan.
And my name is Brent.
And we're the hosts of the show.
On Chit Chat Stocks, we are constantly researching new stocks from high flyers to undiscovered small caps, diving deep into business models, debating competitive advantages, dissecting valuations, and we have a fun time while doing it.
Supercharge your investing research and start listening to the podcast today. You can follow the Chit Chat Stocks podcast on YouTube, Spotify, or Apple Podcasts. Follow the show so you never miss an episode. That is the Chit Chat Stocks podcast.
Yeah, I think for me, I've really never sold something so that I could buy something else. I don't know, for whatever reason, that's never been a temptation for me, which is the reason staying fully invested for me kind of works, because I will be tempted to, if on the day I have enough free time to think about it, be like, oh, let me use some of that cash. And it could be just not the right day. I could just be forcing myself into a decision because I have the time to think about it versus this is the right time based on market conditions or whatever. All right, so here's another Buffett Munger one that I've often thought, I'm not so sure about this, which is investing within your circle of competence. And the reason I question this one is, while I do think you should mostly buy things you understand, I kind of don't think there's a problem with dipping your toe into investments that you're not entirely conversant with. So, but I think there's some caveats there, right? I'm not talking 50% of your portfolio. I'm talking like in the same way you might invest in a speculative moonshot kind of stock with maybe 1 to 2% of your portfolio. I think keeping like a reasonable allocation to stocks that are maybe not in your circle of competence, because there's, out of the 40 something stocks I own, there's probably a handful that I have a surface level understanding of what they do, but I wouldn't say I'm an expert in that area, right? Like a lot of the semiconductor and tech stocks, anything in the cybersecurity space, CrowdStrike is a company I have a lot of conviction in and I really like, but that's based on mostly the results.
Mm-hmm.
Like they've put up strong results and the business operates efficiently. It's not because I'm a cybersecurity expert. It's not because I know that their ability to defend against cybersecurity threats is any better than this other company. I mean, there's ways that, right? Market share, what people say, Gartner ratings and all that kind of stuff. But I wouldn't say, if someone said, Jeff, is cybersecurity inside your circle of competence? I'd probably say no. But that's been a great investment for me. So I don't know. I'm a different investor than Warren Buffett, right? He's waiting for like the day to swing at the pitch with a ton of money and make one correct decision.
Right.
That's just a different ball game, I think, than what I'm trying to play. But I don't know. What do you think about the whole circle of competence thing?
Yeah, so I think there's nuance there. So definitely important to consider who you are and what you're trying to accomplish and compare it to somebody like Buffett. Just as for some context here, if we think about the Berkshire portfolio, this is U.S. held stocks. There's 41 stocks in it as of the most recent 13F. It doesn't include the Japanese trading companies, Mitsui and those companies. It doesn't include certain types of market instruments, stuff that don't necessarily show up. So again, this is just the core stock portfolio of stocks that are held, 41 of them. The 10 largest are 80% of the portfolio. It is an extremely concentrated portfolio. Now, part of that is Apple, but it's not just Apple. The top 4 stocks are all more than 10% of the portfolio each. And then Chevron is 6.5%. So these are concentrated investments, billions, tens of billions of dollars for every single one of them. And when you're making those sorts of investments, you damn well should know these businesses extremely, extremely well. It's just the raw numbers, right? And this is not just Warren Buffett's money. This is the capital of the fellow shareholders in the business too, right? So there's a fiduciary, an obligation to the fellow owners of the business to know, right, what it is. And I think that's an important part of it to remember. But I do think that just as that's not necessarily perfect advice for everybody, if we swing the pendulum to the opposite side and think about the idea of, well, it's just a little bit of money, I can throw it at something I don't know anything about, that's worse. That's even worse advice, right? So the idea of having some understanding of what you're owning and then using, to your point, and I think this is important, is using things like exposure, position sizing is ways to start some exposure. And then as you increase your knowledge about it, as the performance of that business pays off and you increase your exposure, ways to kind of manage around that. And the reality is too, Warren Buffett built his investment style from an office in Omaha, where he was having 10Ks mailed to him, right? This is not somebody that does a lot of internet research. My point is not to denigrate his process, but this is a process that he spent 8 decades creating and building, and the way that he looks for companies. And it's different. We all are able to crowdsource a lot more information and get in touch with actual experts and things that have credibility. And we can outsource that. We can go to 7 Investing or The Motley Fool and pay to have access to good research, right? From people that know what they're doing and build on that research, right? So as long as we're using those resources appropriately, I think it's a lot safer and a more reasonable thing to start investing outside of your area, your circle of competence today, as long as you're, to paraphrase you, learning more than you're trading those ideas.
Yeah, I like the way you framed, not when you quoted me, I always like that, but I like the way you framed it. What it got me thinking was one of the ways you expand your circle of competence is to start taking small positions in some stocks that are outside of it. At least that's for me, right? Because I know that I don't pay enough attention to it unless I own it. I have to have some skin in the game.
Yeah.
That, the degree to which I do understand cybersecurity is because I've owned a couple cybersecurity companies.
Right.
I would not have put that level of learning in if they weren't in my portfolio.
Well, I've talked about that too with my framework. That is an explicit design part of my framework, is that I'm exactly the same. And I think most people are the same way. As soon as you have some financial exposure, you start paying attention, you start learning.
Yeah. All right, here's a much less consequential one, but one that's always rubbed me the wrong way. And I didn't think of it till we started rolling here. So maybe this would have been my number one when you asked me at the beginning. I hate the advice to not check your brokerage account.
Yeah.
I get why it exists. I understand that for some people, they have to put that friction in place because they can't stop from then buying and selling once they're in their brokerage account. And I've heard this advice given most frequently in the direction of new investors. When you're a new investor, you shouldn't check your brokerage account every day or whatever. And I completely disagree with that if you're the kind of person that has self-control, because I've mentioned this before, but I think it's worth revisiting. When I was a brand new stock investor and I was buying essentially penny stocks in a Robinhood account with $50 to start, I checked that damn thing, I don't know, every 7 or 8 minutes all day long. I just kept refreshing the app as I was in between meetings and stuff at work. And that was part of just, it was new and exciting. And I was, seeing how it worked. But over the next several weeks and months, as I checked in on it pretty frequently, I learned a bunch of stuff that I didn't even know was possible. I had no idea an investment could go up 7, 8, 10, 15, 20% or down by those numbers. My conception of what money could do was limited to interest rates.
Right.
Like my understanding was like, oh, I know interest rates are pretty low, so I'd expect like stocks to move like 1 or 2%. I was so oblivious to all of this. And this was February, March, April of 2020. So I learned pretty quick, both down and up, because there were some up movements in that crazy downtime, just how much stocks can move. And I needed to know that so that when it happened a month later, I wasn't like, oh, this is odd. It was like, oh, this happens sometimes. And so I don't know. I feel like when you're in that excited learning phase, you should look a lot and learn a lot and try to just, and I was also fascinated by all the stuff that's in there. Like I didn't know what a market cap was. I didn't know what the PE was. I didn't know, I mean, I knew what dividends were, but I'm just thinking of the basic statistics that like your brokerage app will give you for the stocks when you like click on it, right? And being in there and looking around and Googling stuff and watching little training videos that the brokerage gave me was helpful to my learning. Now, I'm also wasn't the kind of person who was just constantly buying and selling. So I get that for some people, you and I know people who don't even keep the brokerage app on their phone. Like they force themselves to log in on their desktop to make a decision. I don't know. I just feel like there's got to be enough people out there who can look and not trade that to just tell new investors, like, don't log in, I think is bad advice.
So this is two things. So this is just to show people how weird my brain is about stuff. This is also a little Buffett, maybe a little racier than something Buffett would say, but not a lot racier. Looking at your portfolio, looking at your brokerage in March and April of 2020 to learn about what stocks do is a little bit like learning about sex by just watching porn. It's like, it's possible, but that's not what it's like for everybody. So
yes, you're right. But it did teach me, I guess, what can happen.
The extremes,
sometimes. The extremes. Yeah.
It's like, no, absolutely. So that's one thing. And we had Ben Carlson from Ritholtz on a month or so back, and he was talking about this, and he talked about exactly what you're saying, is that the reality is it's terrible advice because it's not advice that almost anybody that's sitting across from you or that you're having a conversation with is going to take. Chances are, if you're interested in individual stocks, you think this stuff is interesting and it's compelling. You also think you can be good at it because you're the kind of person that's been successful in life at things, and you think you can be good at this thing too. So of course you're going to look, right? You're going to. So I agree. It's terrible advice. The better advice is, again, your learn, not trade. It's being aware that it can happen. And for me, this ties into that something that I think directionally can be good advice, but broadly in the financial services industry, because so much of that industry is lazy and just chasing a dollar figure, the concept of how to manage risk around risk being defined entirely as volatility. You've talked about your experience with your 403B, where the conversation you had when you were onboarding for that around risk being, no, I don't want anything risky. And a 20-something person being put into bonds and cash, right? And then the risk became opportunity cost, right? Because there's no opportunity for upside where they're entirely putting you into a low volatility asset. And that's one of the things I like about putting people in front of a brokerage account in those periods, is so you can see what happens. So you're aware that it's a thing that can happen, but then getting through it and seeing what happens a year or 2 or 3 later, where the value of the business eventually is what drives the price of the stock.
Yeah. And I'm glad you brought up the risk appetite thing. I was going to mention that too. And I struggle with that one because the hard thing about that experience for me was I felt very uncomfortable with the fact that I had to sit down with the rep from the company whose job it is to sell me on getting a 403B through their company. And the dude was really nice. Like I worked with him for, a bunch of years as I changed jobs and stuff. And because every time I changed jobs, I had to move the account.
As Brent Beshore from Permanent Equity says, nice isn't kind.
Yeah. Yeah. But I say this because I'm not going to like say who it is, but I don't want to throw this guy under the bus. He's doing his job. His job is to get
Not well.
teachers to it. Well, he did what I wanted him to do. And here's the thing about me when I was 23. Had he tried to convince me that what I was saying was wrong and tried to explain that you're young, you have plenty of time, I would have dug my heels in.
I can confirm that this is a true characteristic.
And I would have said no.
And
I probably would have just not signed up. So he probably was reading the room and just figured like, all right, I'll let this idiot do what he thinks is right. But I let's dive into the whole risk appetite thing just generally, because I do think that's another area where you'll hear very dogmatic opinions being expressed as facts in terms of how people should think about risk. And risk can mean a lot of different things to a lot of different people. Like to me, risk was don't lose money. But I wasn't thinking about the risk of not having enough money 40 years down the road.
Right. Right.
And maybe, I don't know, maybe if it had been explained that way, I would have been less obstinate about it. Probably not. But then I think about, even now, like when my wife and I have very different levels of risk tolerance and we're about the same age. And so that's like a conversation that we have to have pretty frequently too about, how we each think about risk differently. So I'm just curious, like where you hear bad advice given that's meant to be good advice around risk, but could be bad for some people.
Well, it's the two ends of the pendulum. The first one is when telling people early in their saving and investing career, really taking the time to make the nuanced discussion around what risk really means and defining it properly, which is permanently losing money. And investing through a stock market downturn, 15 to 20 years before you retire is volatility, right? That's not necessarily a probability of permanent loss, particularly if you're investing all the way through the downside, right? And then the other end of it is when you have investors who have done well, but now they're approaching a finish line and they've gone through a period where they've done extremely well through stocks and who still have substantial amount of stock exposure and not having the courage to, or even just the skill set and the nuance to help those investors, help those people make that transition back to refocusing on what their goals are and not just spending their time looking at that portfolio that keeps getting bigger and saying, well, the pigs thing happened back in 2011 and, we didn't double dip and then the market just kept going up. And then the pandemic, that was what, 3 months? And then, we had that, 9-month thing back in 2022, but look at where we are now. There's a million excuses that people can come up with that are all entirely biased around the performance of their portfolio and expectations that they can continue that run and are missing out on the fact that the biggest risk to them when they're planning to retire in 6 months has become volatility, right? We've come completely full circle. And now volatility is a risk because if you need to sell that volatile asset in 6 months and that volatile asset falls in price by 25 or 30%, and then you sell it, that's a permanent loss of capital, right? You will never be able to recoup that because you've now sold it at a lower cost and spent the money on something in your life. So having those nuanced conversations at the beginning and the end of people's investing careers is so extremely, extremely important. And it boils down to a stupid survey that asks like 5 questions, and it's using risk as the proxy for, or volatility as the proxy for risk, and it's not. And it frustrates the shit out of me.
Yeah.
Do I have to bleep shit?
I don't know. You just said it twice. You're the final edit, so I guess you can make that decision.
Okay.
All right.
I'll let you know what I decide.
Here's another one that rubs me the wrong way. So I often hear the advice given that basically, other than maybe a mortgage, you should have no debt in your life. And I'm going to give an example from my own life where I think I struggle with this one. So we renovated our kitchen and part of the downstairs of our house in 2021 during the pandemic. And we borrowed money to do it because we didn't have that much cash outside of our emergency fund to do it. And as soon as it was done, it completely transformed our house in a positive way. And I remember saying to myself, God, I wish we did this 5 years ago, because I saw immediately how it was going to make living in the house that much more enjoyable. Now, we certainly we had less money 5 years prior. And now here we are 5 years later, 4 years later. Yeah, 5 years later. And if we were doing it now and we wanted to, we probably could have paid for it in cash, or at least most of it or a lot of it, and then maybe just borrowed a little bit less. But then I would have been saying, God, I wish I did this 10 years ago. And
Right.
now I'm in a lucky position. The only debt we have between the two of us is our mortgage, the little bit of the kitchen we're still finishing paying off, and my used new car that I bought about a year ago. That's it. We have no college debt. We're fine. So I understand that for people who have $60,000 worth of credit card debt, they should not take on more debt. I'm not saying that, but I think in some circumstances, like, yeah, am I paying more for the kitchen renovation because I borrowed the money? Yes. I'm not naive to it. Same thing when you have to buy a car. Like sometimes you just have to buy a car because your old one broke, or you're unexpectedly having triplets and now you need a minivan and you don't have 20, 30, 40 grand sitting around. So you borrow money and buy a car. And I think if someone says to you, you should never have debt, and then you give them some of these scenarios and lay out your own finances, I think even the people who say that would be like, oh no, I get where you're coming from. Yeah, that's fine. But it's never presented that way. You know, we've had people on our podcast who have said things like, you should have no debt. Don't do debt. So I don't know. It's just another one that's presented as fact, where if you don't know any better, you might, put off something that would be a benefit to you and your family that you actually could afford, because there's this dogmatic, thing in your brain of like, no, don't take on debt. I think it's an admirable goal. If I could go back in time and pay for the kitchen in cash, I would have. If I could have bought all my cars in cash, I would have. But that wasn't where I was in my life at that time. So anyway, that's another one that bugged me.
Yeah, I think when it comes to debt, and never and always, I think probably the only time that I agree that you should never have debt is credit card debt.
Yeah, I agree with that.
You should never carry over credit card debt. Now, we buy like our recurring stuff that we buy, groceries, even some utility bills where I can, those like the stuff that we spend money on.
Yeah, you get those miles.
I get them miles. Man, I get the miles. But I pay it off every month. I pay it off every single month. Like I would go so far as to say, if you have credit card debt, spend your emergency savings to pay it off. Because you know what you can do if you have an emergency? You can put it on the credit card, right? Yeah. But you're not going to outrun the interest rate on that. So you are going to net be better off if you use some of your emergency money to pay down and pay off credit card debt. Get it gone, like make it gone from your life. Because once that's gone, your money's immediately 25% more efficient, because you're not servicing debt that's cost you 25% in your interest rate. So beyond that, I think it's largely BS. So the one that drives me the craziest is don't use debt to buy depreciating assets. What the hell does that even mean? Stop it. Okay, yeah, I know a car is a depreciating asset, but you know what? It doesn't matter if I need the car, and the interest rate, the cost of capital is what matters. If I can get a low interest rate on a car, and it's going to be advantageous for me over the 5 years that I'm paying that loan to keep that money invested, right? Then I would be far better off keeping it invested, because the yield arbitrage is better. I'm earning more on that money, invested in high yield dividend stock that's growing the payout, than I am just paying off the car, right? So even from a financial perspective, it doesn't always make sense. But sometimes too, just as with the use your emergency funds to pay off your credit card, don't use your emergency funds to buy a car, because you can use a credit card right now in the emergency room. I can't give them my car note in the emergency room and say, hey, you want a piece of the equity of this vehicle? it doesn't work. Liquidity matters sometimes, right? And sometimes the liquidity is more important than carrying debt on expensive things that you could have for a very long time. So yeah, and something like your house, an improvement like that, if you earn enough money that servicing that debt is not onerous and it's not going to affect the quality of your life, but having that remodeled kitchen or the addition in your home or some other thing, that's going to improve the quality of your life. Isn't that what we're doing all this for anyway? Isn't like the whole point of the money that we earn and the wealth that we're creating in savings to give ourselves a better life? Go get you a damn HELOC and remodel your kitchen, have the kitchen of your dreams. Go do it. Go pay $700 a month, whatever. Go do it. Absolutely. And those frugal, boring ass people in their beat up old houses that need to be remodeled, and that's all they do on the weekends is remodel their house because they're being cheap versus just paying somebody and going out and living a good life and going on vacation down to Cancun. I don't resent those people at all, because if they love doing that, that's fine. But you know what I want to do? I'm going to go to Cancun. So,
well,
and I say that, and I'm the guy that paid cash to remodel one of the rooms in my house.
Yeah. There's a podcast I listen to that I actually like where it's a lot of personal finance advice. And some of it is, the hosts have very strong views on certain things. And that's the only aspect of it that bothers me, because there's sometimes not the do this, except maybe here. And I get why you can't always do that if you're doing a podcast, right? Anything gets dragged down in a conversation. This is not like our show where the conversation is the podcast. And I do think, just to kind of take a step back from this whole conversation for a minute, I do think that a lot of these good advice things we're talking through are probably right a majority of the time. They're probably right for a majority of people. There are a ton of people who do less than optimal things and justify them, sort of like we're trying to do with our contrarian takes on all these pieces of good advice. But I think, the part of this that is important to me is all of this, I think, is what makes being fluent in investing knowledge and personal finance know-how a little overwhelming, because there's always people saying, do this, and it's self-help-ish and not conversational. And I think the only time you get the conversational piece is if you pay a financial advisor to sit down and talk through it with you, or listen to our wonderful podcast where we will talk through everything. So another direction I thought it'd be fun to go in is, when we talk about investing, we talk about how being a contrarian is sometimes a good skill to have, right? If you run towards a fire, and you could potentially find like a great investment, right? Everyone is running away from this stock. You see something they don't, you buy it, your returns are great, and you have this cool story to tell. So how do you think about contrarian thinking to good advice? I find myself, every time I hear someone pitch something as, here, you should do this, I do find myself being a little bit of a contrarian and thinking, well, I don't know if I agree with that in all situations, or I could see where this could be the exception to the rule. But I don't know, do you think people get themselves in trouble if they are too contrarian as it pertains to, good advice that they receive?
Yeah. First, I want to address the little bit of self-interest, little introspection that you had there, the self-reflection. If I had a nickel for every time your initial reaction was like, yeah, I don't want to do that, and then eventually you would absolutely embrace that idea, I'd have like probably 4 or 5 nickels, right? That is your default setting, is like, yeah,
it is. I am a default contrarian. I agree with you.
Yeah, it is. It is. So I do think that broadly, like, the idea of being a contrarian sounds good, but let's talk about being a contrarian within the context of being an investor and investing in stocks. If you're always contrarian, you're wrong 70% of the time, right? So I think the idea of being contrarian is dangerous, and it has to be applied with precision.
Yeah.
And in things that you have a real edge in, like, like that circle of competence where you see, and it's not bias, right? Working in the auto industry doesn't make you an expert on auto stocks, right? It probably means you're going to make bad decisions because it's a crappy industry to buy stocks in for the most part. But the point is places that you actually really have an edge. So, and I know I've beat this dead horse a lot of times, but I'm going to beat it one more time. back in 2023, that spring when we had there was a panic with banks. People were afraid. We saw 3 big banks fail, and there was concern that there were going to be systemic issues and more banks were going to fail, and depositors were going to run on some big banks, and the FDIC was going to have a whole lot of banks that it had to find buyers for. And I saw opportunity. And that's one of the handful of times in my investing career that I took substantial amount of capital and I ran towards the fire, and it worked out really, really well and a lot quicker than I expected it would. So, but it's an area that normally, I have a little bit of exposure to. I talk a lot about banks, but I don't really have a ton of exposure to. So more than most people, but it's not like a third of my portfolio, I guess is what I'm saying. So, and I think sometimes thinking about Berkshire and Munger always comes up as being like this great contrarian, particularly when we think about the, invert, always invert, right? The inversion principle. And I don't think he was necessarily trying to be contrarian as much as he just wanted to think about stuff, really think it through, and invert it, meaning not go in the other direction, but flip it over and see what it's made of and poke at it until you find the holes, right? And you find the weaknesses. And sometimes when you do that, you find the opportunities. But I think when it comes to financial advice and investing advice, being a Munger with the idea of really inverting everything and putting it through some sort of a framework of not, oh, that sounds like great advice, but what are the downside implications if I act on this advice, right? What are the implications for me if I follow this direction?
Well, and the perfect example of this, I think, is tech stocks in the last 20 years.
Yeah.
Because, you can go on social media any day and you will find someone or someones who are saying, this can't continue. NVIDIA can't keep doing this. Apple can't be doing that. Google's going to fall. Just constant, this has to end. And at some point, it's sort of like the people who call, 87 out of the
35
last
of the last 2 recessions. Yeah.
At some point they'll be right. But if you had been, if you're a contrarian in that sense, if you're a contrarian against the S&P 500, like you said, you're wrong 70% of the time. I will say, to defend my natural state a little bit, having a contrarian leaning can prevent you from getting caught up in euphoria.
Yeah. Absolutely.
But, I think the way that I've thought about the Mag 7 and talked about the Mag 7 stocks on this podcast over the past couple of years is an example of where I feel like the contrarian thinking can be good, but also like I don't let it overcome me, right? Because I talk very openly about, I don't know what to do with the Mag 7 stocks. I part of me is like, this can't keep going. NVIDIA's got to come down. And then it hasn't,
Right.
So
right.
I've actually ended up not making a lot of decisions around any of those stocks because of that. Just, but I also haven't piled cash into them because of my contrarian view. Right. So, and I don't know, I think that this is why I wanted to bring it up. Being a contrarian is another thing I see portrayed as truth, especially by the people who view themselves as contrarians. Right.
Right.
You'll never be rich buying these stocks. You have to find, Lithuanian rubber companies and things like that.
Are you picking on Tyler right now?
I'm not picking on Tyler. I'm just saying there's a lot of people out there who are successful contrarian thinkers, but they present them. Tyler does not do this, but they present themselves.
That's true. He doesn't. Yeah.
Yeah. But they present themselves as like, this is the only way.
Right. Right.
And again, if you're
those people are often selling access to learning how to do that only way too. Right.
And if you're a new investor and don't know any better, and someone's a very convincing contrarian thinker, you're like, oh, that makes so much sense. Everyone else is in this stock, so the price is really high. So I should go find, an Azkabani rug manufacturer. So anyway, I want to throw that one into the conversation.
Yeah, no, and I think that's right. And with that said, I think there are a lot of universal truths. That's very different than that meaning that particular truth or idea or principle applying to you today in your current situation is good advice for you, right? I think that's the key. And I think stock picking is a good example. One of my favorite things about this glorious thing that we get to participate in is that there are just as many ways to be successful as there are to screw it up. There are a lot of ways to be successful buying stocks, including investing in Lithuanian rubber tree producers, right? There's a lot of fun, interesting ways to be successful in it.
Right. Well, and that's sort of what I'm getting at is like, for some people, the advice of being a complete contrarian is the right thing for them, right? Like we know investors who are like that.
Yeah.
Jim Gillies is the perfect example, right? He's the kind of person who, he'll own a quote unquote popular company here and there if the price is right, but he likes to turn over rocks and find hidden ideas, hidden gems in Canada. And like, that's his wheelhouse, right? That makes him happy. He's good at it, whatever. But like, other than like just following his stock picks, which you can do if you subscribe to his service, that's a difficult thing for, I think, a lot of people, a difficult way for a lot of people to invest, right? You have to have a certain kind of mindset and time to do that kind of investing. So, all right. Yeah. That's all I have to say about that.
Yeah. Well, Forrest, I think you've said enough about it. It's good. I think it's a good point. I'm glad you circle back around to that one. All right. So I guess our summary here is there's lots of good advice out there, but it might be terrible for you. So think about it. Like, actually think about it. Think about it within the framework of what you're trying to accomplish and whether it gets in the way, or maybe it's good because it gets in the way of you doing something wrong.
Yeah. And I think the last thing I want to say is if you have a piece of advice that you have heard portrayed as being like, this is the way, and you disagree with it, let us know. Hit us up on social media, send us an email. I'd love to hear what our listeners are thinking as they're listening to this episode, because I'm sure there's other pieces of advice that we didn't even think of, or, didn't get a chance to talk through, that are out there, and people hear them and say, I'm not so sure about that. So I'd love to hear what everyone else thinks about it.
Yeah, it's a great idea. Email us, find us on social, but just go give us that 5-star review.
Right. Yeah, we won't get the message unless it's preceded by a 5-star rating and a written review on Apple Podcasts.
Right. And get the message means we'll ignore it until we see your review. You can do it, people.
No one's giving us ratings or reviews, so I think these threats are being viewed as empty, Jason.
Yeah. That's true. I think we've beat up the financial advice world enough for one podcast episode.
Yeah, agreed. I have some advice. Why don't you end our episode?
I don't know if that's the best advice for me, Jeff. All right, fine. I'll take it anyway. All right, everybody. Thank you for joining us on this conversation. Thank you for remembering that our advice is great, but it's not great for you. Our answers might not be your answers. It's up to you to find your own answers out there. You know what? You can do it. I believe in you. All right, Jeff, we will see you next time.
See you next time.